Welcome to After Hours at TradersPost for Friday, September 26, 2025. I'm one of your hosts, Tom Hartman, marketing manager here at TradersPost, joined as ever by Peter, Exit Liquidity Hartman, to break down the market madness. After Hours is your go-to live stream focus on macro trends for retail traders, brought to you by TradersPost, the best advanced trade execution engine known to man. But more on that later. For now, let's focus, as we always do, on the dollar, on risk equities, and policy. This week was a bit of a roller coaster ride, Peter. I have to say, actually, the last 2 weeks has been pretty interesting. We had the Fed meeting on the 17th of September, which, when it came to markets here, if we pull up the NASDAQ, take a quick look, we had a massive drop. This is the candle drop that we had here for the NASDAQ. So we went from a peak to trough of something like 1.63%.
Yeah, that's not a big deal.
Well, I wish we have who can move the markets with their breath. Trump, Elon, and Powell.
Elon has that level. I mean, unless he's talking about Tesla, what can Elon do?
I guess what is part of Doge. Well, yeah, I guess his own stock he can move pretty dramatically.
Right.
So let's call it, all right, just narrow it down to Trump and to Powell. So they speak, I listen. So later on in the show today, we'll actually talk about what might have caused Powell, him speaking again, causing the markets to drop significantly as of the 23rd this week, which was pretty crazy. But taking a look at the dollar, what we see here is the dollar did a bounce back from the lows that has been pretty incredible. This low over here, just like the chart we saw before for the NASDAQ, this low, this candle, where the DXY futures or the DX futures hit a low of 95.85, happened on when the Powell meeting happened, when the Fed presser happened. So that was a breakdown below this channel that we had been watching since, let's call it June. Just this narrow channel that we've been in, and we were expecting that this was the final drop where we would be heading lower. And if that happens with the dollar, well, we all know what that means. Risk assets up, crypto up, NASDAQ, S&P, Russell, good times roll, even gold could go up under those circumstances. But then it completely reversed. The dollar came not only all the way back up into the channel, it's getting up towards the upper end of that channel. And
that's bad news, right?
Generally speaking,
people are running towards dollars. That means a flight to safety, sort of.
Yeah, so it could be flight to safety. We had and gold is still up too. So if we have gold up while dollar's up, let me just pull that up here. When you have dollar up, gold up, it means problems in the financial system, problems within the plumbing of the financial system. Confidence within the system is low.
Now, does that mean that could be good because of liquidity being injected? Right, crisis leads to money printing, right?
Well, let's leave the terms good and bad off to the side.
All right? You don't want to have a morality argument? What's your ontology? No, I'm kidding.
Well, you just want to say bullish or bearish, right? This is one of the great turns of phrases that the Wall Street people and High Street people have given us. We don't have to think in terms of good or bad. If you're long an asset that goes up, bullish, then fine, good. If you're short that, bad. So there's plenty of people who would want gold to go down and for the dollar to go down. So it's not good for them. Right. And when it comes to the economy, well, things that are good for the stock market, almost definitely not good for the economy. But let's just leave that aside. But with the dollar up, gold up, you're right. The response, the hopeful response from that the market participants wants from the Fed is, hey, bring in that cowbell, bring in that liquidity. Let us inject these markets. Let's get these numbers up. It's certainly what Trump wants. The issue here with the dollar is that when the dollar moves the way that it does, the long-term trend for the dollar is you're not changing that because of a couple of things here or there. Like the dollar reflects structural problems within, or structural truths within the economy. So if we zoom out for the dollar to the daily chart, these dollar trends happen for long periods of time. Let me zoom out even further. These trends happen for a long period of time. So we've been a bull market for the dollar since the global financial crisis of 2009, right? But further out, the dollar is structurally bearish over time. So we could be at the top of this channel that makes the dollar come all the way down to 63, which would be a Peter Schiff dream, just the dollar being absolutely tanked. And if that happens, if we're talking about good, talking about bullish, gold could be, I mean, 6, 7, 8, 9, 10,000.
What?
Well, of course. If gold's been rising instead of a rising dollar situation now since 2009, if the gold's been going up then, and then the dollar tanks, so that means everything price in dollars goes up, well, gold could skyrocket. All these assets could absolutely skyrocket.
What an interesting times we're living in, Tom.
That's right. So we're really, all eyes are peeled on the dollar to see what it's going to be telling us, because the dollar don't lie. The dollar don't lie. All right.
The dollar is like Beyonce's hips.
That's right.
That reference, right?
That's right. And it brings all the the boys to the yard with its milkshake.
Okay, I don't think that's Beyonce, but yeah.
No, that's
right.
Brent. Ooh, I forget his last
Nobody
name.
cares. Nobody cares. Nobody cares.
So the next up here for risk assets, what are we taking a look at, is that we've had a bit of a dip with the NASDAQ and equities over the last couple of days. So if we zoom down here to the 2-hour chart on the NASDAQ, we can see here that from peak to trough, we had a drop of 2.29%, which is significant. This is from the 23rd of September till now. Now, the big question is does that mean, is this a end of the bull market sort of scenario? Are we headed in for, now we're going to make lower highs and we're going to head down lower and march lower and march lower and march lower? Yes. No. Maybe. We got all the keywords in there. Right? So what's been interesting, you have a drop like this in equities, which with a corresponding drop in Bitcoin. If you guys remember, I think last week we talked about it where Bitcoin had been falling. Bitcoin's been falling since the 18th of September. So it didn't get any boost because of Powell or anything like that, really. We've had this drop. And that's because although both equities and Bitcoin respond to global dollar liquidity, Bitcoin almost exclusively responds to that as far as the macro trend is concerned, whereas equities can also move based on the options market. Now, because we had that divergence, what I've been saying is that my base case would be that the equities would come down to match where Bitcoin is. Because once the options market cleared out that move, then you would have the correlation that will come into play, at least with tech stocks and Bitcoin, and then as a function of that, a bunch of the members in the S&P 500. So that seems to be what we got. We got a drop in equities and a drop in Bitcoin. Now Bitcoin is still dropping, and equities have bounced up. So to me, I fully expect, for now, for the time that we're in, that this bounce in equities is to a lower high. That this is the bullish trend. It fell. We bounced off a daily unmitigated level down here. For VWAP, we bounced back up. I think this is the lower high. We don't really get much past 24,750 on the NASDAQ. And then we roll back over, aiming for 24,158. I believe Mike on Price Action Live has 24,200 as his current zone to pay attention to. That means that would be a drop of about another 2.33%, which is enough for people to make money, enough for people to go on, make enough money to go on vacation, to get another car, to pass your prop firm accounts. When we get a move like that, the reason we talk about this stuff as traders is that if we get a move like that, and you could hold on to that, and you can take advantage of it, you can make quite a bit of cash.
So what's the trade?
For me, the trade would be, not financial advice, do your own research, shorting NASDAQ from wherever we are right now down to 24,150, or let's call it 24,200.
Mm-hmm.
And obviously I'd be negated if we made new all-time highs, but also if we made a higher low up here. So like if the price fell down, if the price rose a little bit, let's say to 24,916. So it comes up over here. It doesn't make a new higher high, but it moves up over here, comes down, makes a higher low, and then continues. Then I would say, okay, we could be back in the bull market. And October 20th is really my end date. No, sorry, not October 20th. The end of September is a quarterly option expiry period. It was one of those periods of weakness throughout the year that Ken Carson talks about, where options could cause some shenanigans within the markets. So it's not crazy that at the end of September, that's what happened, right? It's not crazy that
we heard about Ken Carson.
Oh, he's my bro. He's my buddy. He's my pal. My friend.
Drink.
So totally expected to have a drop like this at this period of the year. So once we get past that calendar date, once we get past that risk, we can get a rise. Now, let's put this in context, guys. This is still bull market territory as far as the market's concerned, right? This is the low of April from when this is the whole drop from Trump and the tariffs, right? So people thought bull market is over, recession in the works, tariffs are coming, huge sell-off. So that was a drop of about 25%. So this little baby 2% drop is nothing. We already recovered half of it. So let's put this in context, and then also put it in context of what the overall market does over time, up and to the right, folks, which we'll talk about in a second with Luke Gromen, who did an interview talking about just this, why stocks always go up. But that's what's going on right now. Now for Bitcoin, just to put that on the table, I do believe there is a possibility that because Bitcoin is not responding to the options market that happens in equities, that we get to on Bitcoin 104. That would be the level I'd be looking at for any sort of bounce. And of course, if that gives up its ghost, then the next level down is at 92,000. Do I think we get to 92,000? I'm not sure, but it depends on what goes on with the dollar. Dollar goes up, Bitcoin will go down.
Why don't you, this is just some advice. Why don't you draw some more trend lines on your chart? I just feel like there's not enough.
There. Is that a little bit better for you, Peter? Does this help you?
I don't know. What am I supposed to? It looks like you were angry at your chart.
There.
How many trend lines do you folks have on your chart? Put the number in the chat. Whichever comes closest to what Tom has without going over will win 1,000.
All right. So last point of news here for policy. So this was interesting. We had the GDP numbers come in for come in this week. And so this week GDP came in at 3.8%. Make that a little bit larger. GDP quarter over quarter came in at 3.8%. All right. So previous was negative 0.5%. Good for the economy, but not bullish for markets. 3.3 was the expected, and it came in at a better 3.8%. The markets didn't like that. The markets don't like that because, and that's one of the reasons we got the sell-off here in. We got that sell-off earlier on. This was on the 25th. Yeah, so on the 25th, the market fell that day just brutally, almost 1.5%. It fell down because the market has been pricing in rate cuts. And the better the economy does, the less rate cuts Papa Powell can do.
If I was a major company right now, like some big company, I would just fire as many people as I could and just claim that I'm trying to help the economy. Look, bad news makes good news. So for the sake of the country, I'm going to fire me at Microsoft. I'm going to fire 80,000 employees to get the Fed to like kind of wake up, just wake up. Anyway.
Well, I think we could always expect bad news to be coming, so shouldn't have to worry about that. The question is, we can get all-time highs after dropping 20%, right? Is that what we want? Do we want bad news happens, market drops 20%, and then we get the cowbell? I'm not sure we want that.
Vigorously. Yes.
Well, we're going to step in a second after a little word from our sponsors. We're going to step into what Powell said this week and what Luke Gromen did. Super interesting and something you definitely want to pay attention to. So we'll be back in a moment.
Ask yourself this. Are you making trading harder than it needs to be? If you're trading manually or still coding just to connect to your broker, yeah, it's time to upgrade. TradersPost lets you automate trades using signals from tools like TradingView or TrendSpider or even your own custom setup. It works with brokers like TradeStation, Tradeovate, Coinbase, and a bunch more. I've been using it myself, and getting started was smooth. The platform's clean, setup's quick, and once it's running, it just works. And when you're ready to scale, adding more strategies, plugging into prop firm accounts, or juggling multiple portfolios, TradersPost handles it. It's built to grow with you. Start your free trial at TradersPost.io. Trade smarter, automate your edge.
A Ventura trader here says, in response to the number of trend lines he uses, none, I fly blind. Baller, all right? Baller. I bet he drives without a seatbelt on, and when he's on the plane and they say to buckle your seatbelt, he's like, not going to do it.
I only use I use trend lines a lot less now. I just use them for Bitcoin specifically, for long-term assets. Short-term trend lines are sort of silly, but VWAP levels are the thing for me. Like, you get VWAP levels in there, you get places where the price will move. The thing is, with longer structural shapes, trend lines on the chart, because other people are using them, there is a feedback mechanism where the price does move in that area. And so it doesn't tell you, if you see a pennant, it doesn't tell you that the price will break. It just says that if it's going to break, it'll have to break within this period of time, which usually is true. I found that you got to treat trend lines like they are pieces of wood floating around a river that a cork is floating in. So the cork is the price of the chart, and it's bouncing against these logs. Some of them are smaller, some of them are bigger, some of them are removed, some of them are added in, some of them are fixed, some of them are swishing around. And when you draw the trend lines and you see the price hit those trend lines and hit where they're supposed to me, that's like, yeah, I'm seeing multidimensionally here, Marty. I'm seeing the flotsam floating around in this river. So you forgive me with my number of trend lines on the chart. That's what I'm going to do. Peter,
I forgive you. Yeah.
The two men whose words move markets, just their tweets, just their words. Trump and Powell. And Powell decided to open up his trap this week.
Don't speak ill of our Lord and Savior.
He was at the GPCC Economic Outlook forum that happened this year. I think it happens every year. This is the Greater Providence Chamber of Commerce, where he was given his outlook for markets, and he said something in here that many credit for being the straw that broke the camel's back that caused markets to fall precipitously. So let's go ahead and take a listen here.
That's right.
And how, let's talk about how the average consumer is going to see any difference in the intervening months relative to an easing of interest rates and the ability and maybe even more confidence to spend.
So we don't.
Okay, so that's the question. That's the question about what is the average consumer. She says average consumer. I find that a little bit more polite than when they call us regular consumers. It's like, oh, come on. Can we just call us people? At least Obama had the decency to call us, and Bush called us folks.
Folks.
Which, if you read Susan Jacoby's book, Age of American Unreason. She has she does not like that idea of folks. Folks was a term you use for human like low life, and it was to make the politicians seem down on your level, but then became just the normal thing. And everyone says folks and y'all now. Anyways, I'm not here to preach that. Use folks if you want to use folks. So here she asked the question that we saw last week at the Fed presser. What's 25 basis points going to do for the average consumer? That's what she just asked. All right, so let's hear his answer again.
We don't set mortgage rates, but when we change the federal funds rate, it will affect the mortgage rates and also all other consumer borrowing rates. Really, all interest rates that are on a floating basis will move a little bit or even a lot if they're short term, based on our moves. So the people will feel that over time. Also, it's not just these days. The market is pricing in the next 6 months what's going to happen to rates. So this is something that wasn't really the case, 50 years ago. Now markets listen to us and follow, and they make an estimation of where they think rates are going, and so they'll price things in. And so, longer term rates will move because of what the market expects. Market participants expect us to do. So you'll begin to see, and you're already seeing, changes in rates long before we make the decision. It can often be already, priced in.
Okay, so tell me what that means. That what he's saying there is that the markets are already pricing in the decision that they're going to make before they make it. If this is not Minority Report level stuff, I don't know what is. Okay? Just hear what he said. First he's talking about the bond market, right? He's talking about the bond market, but the bond market underpins a bunch of the other markets. These all work in symbiotic relationship. So he says we modify the 25 basis points, and that'll modify the short-term rates, overnight rates, 3-month bills, 6 months, 2 years, that's so on and so on. And then as that affects that, he says it ripples out to the 5-year, to the 10-year, to the 20-year, 30-year, whatever, and then it'll affect mortgage rates. It'll affect car loans. It'll affect a bunch of other things. And so he goes, but don't even worry about that. Like, if you just go by that, if that's all it was, well, 25 basis points is not enough to really move it. It'll take years before it actually moves anything significantly. What he says is that the markets are already pricing in the path of rate cuts they think we'll take. So if they think we're going to make 3 cuts, they'll price in 3 cuts. So they don't have to cut. They just need to price it in. And if they price it in 5 years, 10 years ahead, and then people act accordingly because the rates are down as if they had cut 3 times, he goes,
yeah, but
job done.
Yeah, okay, but if they then don't follow through and cut, then people are going to learn, oh, my forward guidance was wrong.
Yeah, well, yes, but by that point, you already made your decisions. You already bought your house. You already bought the car. Well, you won't do it again. The next people will do it again.
Okay. Dark.
So he's like, don't worry about the rate cuts. Don't worry about the rate cuts. Did you not see how the markets price in what they believe we're going to do before we do it? Her follow-up question should be, so how do you decide what the market should do before you do it? For guidance. We talk. We say we might. They don't even say they will. They go, we have a dot plot. We sort of project out what we think might happen and the past sort of things. And we have a bunch of people and we sort of vote and we can dissent and we can change a little bit. But you can get a sense of what what our rate cuts will be like. And then you price accordingly. So you don't have to wait for rate cuts for the market to move in the way that you think it's going to move. That's the whole point of me showing this. That you need to make your move, not financial advice, do your own research, but you got to make your move based on when they start whispering things. When they send out a board member here and a board member there and they put out this paper and this information comes out, that's when you make your move. That's when the start of the move happens. Not after Powell standing at the podium saying they did what they told you going to do 3 months ago. Okay? That's why he was at Jackson Hole last summer saying, hey, we think it might make sense to cut rates. Why? So that the market's already pricing rate cuts. So by the time you stand at the podium, fait accompli, as you might say in Spanish. All right.
That's not Spanish. And if you don't tell people the English translation to your French statements, then what's the point of even saying it?
It's one of those elite things that if you don't understand French, get out of here. Beat it. What are you doing? And if you do understand French, well, I seem pretty cultured.
Fait accompli is a done deal. There.
No, you have to say it like an English person speaking French. Don't say it in the French accent. It's fait accompli.
No. Okay. All right.
Si tu dis en français un fait accompli, no one will understand.
Look, I know enough about Americans. They don't like hearing French. They don't like hearing French. So let's.
That's why I said it was Spanish, Peter. You're the one who corrected me.
You just okay. Go ahead.
All right. So the next part over here, Powell at the same forum follows up with a question where they talk about the prices of equities. Let's hear what he says. Remember, the Fed speaks in whispers.
Is it fair to say that the Fed and the markets really have a higher tolerance for risk today, more so than perhaps before the pandemic?
I think if you look at some prices, then they're elevated relative to historical levels. There were times before the pandemic when it happens periodically. Equity prices will move up and down, and we do monitor that. But we're not targeting any level of prices for particular financial assets. We don't have a view that we know what the right price of any particular financial asset is. We do look at overall financial conditions, and we ask ourselves whether our policies are affecting financial conditions in a way that is what we're trying to achieve. But you're right. It by many measures, for example, equity prices are fairly highly valued.
Equity prices are fairly highly valued, and the stock market dropped 1.5%. Why?
That reminds me of Elon Musk saying that about Tesla. He's like, I think $800 is too high for our price or something like that. And you're like,
That's
why?
right.
Why, Elon? Why? But you think he's doing that on purpose? That's not a slip up.
It's absolutely on purpose. I mean, they sit around. What do you think the Fed does? They sit around wondering if the word "with" should be in a sentence or not in a sentence. Literally, because they know it's forward guidance. He just sat here and said, "We don't take a look at equity prices. We don't think that they should. We're not targeting any particular price." So he says, "Okay." So you're like, "Okay, they're not looking at it." He goes, "But we do look at financial conditions." Well, the equity prices are part and parcel with the financial conditions. The people who have the assets, if the assets go up in value, then the spread between those who have and those who don't have increases. It financializes the system. It could cause volatility. It causes all kinds of problems. So if you look at the financial conditions, you must be looking at equity prices. And then he goes, they both spoke in euphemisms. She said, there's more of an appetite for risk since the pandemic. That means stocks are up. Stocks are hella up. That's basically what she says. Let me just translate that in SoCal speak. Stocks are hella up. And then he goes, there's no doubt that stocks are higher than their historical averages. He means overbought. He means the stocks are overbought. That's what he means. They're up. They're high. Now, why would the market then drop on that if he's saying that they're not targeting? Well, it's because there's an ebb and flow to these things, right? And so if they thought that, if he had said something like, oh, equities are actually on par for where they should be, then you'd see equities rise. If he goes, oh, I think actually they're lower than we'd expect them to be, we expect them to be higher, then you'll have a massive rally up. Because people are expecting what's called a Fed put, that if the Fed thinks the market has gone too low, which affects the liquidity within the system, the financing for bonds, the financial conditions, volatility, it affects all this stuff. If they think it's too low, they'll come in and add liquidity in. That's the idea of the Fed put. So if he says they're highly valued, that means they would be fine with the prices of equities falling down 10, 15%, and it'd be fine. Well, then you better get out of Dodge if you're if you have $5 billion within the market, you better peel some of that stuff off because they might not care about covering you if the market falls 5% from here. Now, it wouldn't matter, Peter, unless it moves on the charts. That's what we see. And that's why we're paying attention to this here. We want to understand how they actually operate. These Powell at these meetings, the messages that they put out, the stuff in the news, this is how they communicate with us. This is it. Astrology for men. This is what it is. And for women. Not trying to single anyone out. For folks. Astrology for folks. Hey, there we go. We found a use for the word. This is how it's done, and this is why it's good to pay attention to it. All right? Next up, I just wanted to play a little thing from a couple of small clips from Luke Gromen, who was on the Natalie Brunell podcast last week, I believe it was. So this is the BRICS nations hold the leverage and gold and why Bitcoin price isn't higher with Luke Gromen. So the idea here is that I love paying attention, just like Ken Carson, just like specific people, Michael Saylor, specific people within the markets. I like to pay attention to what they're doing because as I pay attention to what they're doing, I get a sense of how their opinions are changing, how the positions are changing over time. And Luke Gromen here has, he was even on Tucker Carlson a couple of months ago, which blew my mind. Luke Gromen's on Tucker Carlson talking about the state of the financial system. I thought that was crazy, but how mainstream macro is becoming. But he is big on gold, and now he's big on Bitcoin. So let's hear from somebody here who's been in markets for 30 odd years of what he thinks is going on, especially as it relates to the treasury market and the valuation for equities, how equities just keep going up.
The markets have begun playing by a new set of rules, which is we have seen 5 or 6 different times in the last 5 years that nothing will be allowed to hurt the treasury market. Treasury market starts to dysfunction, more liquidity comes like that, either by a weaker dollar from the treasury or action from the Fed. And I think they're doing the math around true interest expense, which is like, okay, we need to cut something, right? You know, Doge, the failure of Doge, I think, is not given enough contextual importance, which is, you know, something that we've talked about before now, something I was harping on over and over earlier this year, which is, look, here's what the U.S. government spends its money on. It's spending 80% of all-time high receipts on entitlements to boomers and silent generation. Sorry, excuse me, 70%. It's spending 25% gross interest. It's spending 20%, 15%. No, yeah, $1 trillion on 20% on defense. What are you going to cut? You know, you can't cut entitlements. And, you know, if you think you can cut entitlements, like I would encourage people to look at the tragedy last week and revisit your view. And I think that's, you know, from an economic standpoint, maybe the biggest takeaway of last week, which is if you thought there was a tail chance that entitlements could be restructured in any reasonable time horizon, yeah, like last week marked it to 0. So there is no chance entitlements are going to get marked down. Defense is only going up.
Yep.
All there is to cut rates. So I think markets are beginning to play by this new set of rules, which is bad news is good news. Good news is good news on a nominal base. Like I've got, you know, I think you look at a chart of the S&P 500 over.
All right. So that's the idea here that bad news is good news. Good news is good news. Markets are going to keep going up. It's underpinning the entire global economy, and everyone has an interest. Well, all the powers that be, all the people with money, all the billionaires, all the top class have every interest in the markets to go up and to the right. And that's what we're going to see. There's no reason to believe that's not what we're going to see. Being a bear does not work anymore, Peter. I shorted during COVID. I'll tell you, it doesn't work.
Well, you never, I mean, at some point, the music's going to stop.
Yeah. So
and if that's not soon, I mean, what are we doing here? Anyway, it just, look, I understand the whole market thing and trades and all that stuff, but when it comes to the state of the economy, what he just said, entitlements are not going to be touched. Defense is not going to be touched. All there is to raise rates. Cut rates. You're describing a a doom scenario.
Oh, well, sure. Yeah, the Schifarian future definitely will come to pass. The question is, what do we do in the interim?
Peter shift.
If you're in the desert, you bet on the sand, not on the storm.
I get that. But I mean, it just seems like right now I feel like we might be in a political moment. There's a lot of activity happening on all kinds of levels. I don't want to say those words because I don't want to get the video to be, but there are these things that are happening. And at some point that's going to be happening where we are. If that's not imminent, I can't see that happening in 100 years. I can't see it happening in 50 years. I don't know. I'm a little bit confused.
Well, I thought it was going to happen 20 years ago.
Right.
It's not happening. I mean, it will eventually happen, but it's not happening. And then now with the whole concern was that productivity would drop to such a point where the incremental dollar within from the financial markets spent into the economy would no longer generate a productivity. This is the whole Triffin's dilemma of having the world reserve currency. You have this effect where productivity gets shipped overseas. Now with AI and robotics, now I'm not so sure we don't get the productivity boon. Now the financialization of the markets could actually help it. What happens in crypto, if crypto can be tied into this whole process so that value creation that happens with the financialization of markets also ends up in everyone's accounts. Like you get a piece of that, or there's a possibility to get a piece of that. What happens now with the stable coins when debt gets offloaded into the stablecoin market and there's a new money printer go boom? We don't know all the rules for it, and all of a sudden the debt gets inflated away in this new type of space. I don't know. I don't know if this ends in the way that Schifarian future. I don't know that that's exactly what happens. We could just have another 80 years of this.
That would be wild. If we have another 80 years of this, how do you convince the people at the tail end of this? They'll just be like, look, now I don't believe that the sky will ever fall. And then it's even greater disaster. Look, I think what we need to do, here's the thing. You talked about AI, you talked about robotics, you talked about these things. Yes. But then there are the unknown unknowns that come along with that will cause disruption on some level. Like we don't have everything under control. Never mind the wars and the geopolitical machinations that are happening out there. So there's so much uncertainty that I just don't see. Okay, Tom, if things go down, if there is a bad thing, is there a way to profit on the way down, or you have to make your profit now because there's no way to make it once it crashes?
Unless you have an expertise for it, you're going to find it very difficult to be able to time the drop, right? To make any significant amount of money. Remember, if you just naked short, if you're just shorting just by selling the asset and you're going to buy back, nothing fancy, no leverage, no options, no nothing, the most you can make is 100%. Right. If you hold the market long, you can make 100% every time the market goes up, doubles. So the profit to the downside is so small. Now, the way that you make the profit to the downside is by having asymmetrical bets to the downside through options, through leverage, which means you got to put on your bet in size at the time you think it's going to happen. Well, good luck. If you did that twice a year for the last 15 years, you lost your money. And you didn't make nearly as much as going up and to the right. So the alternative is, I can hear the Bitcoin people screaming now, is Bitcoin. That in either scenario, the idea is that Bitcoin prospers. If Bitcoin is a free-floating alternative, then that's accessible globally, then in times of crisis, people will flee to it in order to store their wealth. If it stays around while the dollar still stays around and there's just a debasement of currency that happens all around the world and that continues, well, anything by virtue of that, Bitcoin has to go up because of the devaluing of the currency. Currency goes down, the assets go up. If it turns out that Bitcoin is a intelligence scheme designed specifically for by intelligence agencies as an alternative to the financial system, and they're planning on offloading into that, great, then also Bitcoin up. So it's like, yeah, the case is here for Bitcoin being your safety is rising. Not financial advice, do your own research, but hey, that's what it looks like.
All right.
All right, so I'm going to end here on this last point from Luke Gromen, who talks about, actually, no, there's two other things. He talks about the liquidity funnel. So how does money actually get into the markets when the Fed is cutting or government is has fiscal and monetary policy that favors financial assets?
Learn more at bitdeer.com. You've spoken a lot about fiscal dominance, where essentially monetary policy becomes subordinate to government spending. But I get a lot of questions about this from viewers that maybe don't have an expertise in macro, and they're wondering, how does government spending end up with stocks at an all-time high? How does the money funnel into essentially these assets? Because I think the first impression that people would have is that, oh, if the government is spending a lot, they're spending it on their employees or maybe infrastructure, government programs. How is it ending up in stocks?
Yeah, I think it's ultimately, dollars are fungible, right? Once you emit it into the economy, you can't control what happens to it. We saw that with the stimmies during COVID, right? It was like, okay, well, toilet paper or TVs or whatever people were buying with that stuff. And so ultimately that means deficits are inflationary over time. Now, I would argue that historically part of the strategy of the U.S. government has been to sterilize those deficits by giving tax breaks that steered the money into financial assets as opposed to real economy, right? So
all right, so basically what he's saying over here, and you guys go take a look at that video in order to get more information on it. It is fascinating, where he talks about that when the government monetizes their debt, well, the government doesn't do it, the Fed does it, but let's say the government monetizes the debt, they're not giving money directly to people to go put into the stock market or to the financial entities. So it's like, how is that happening? Well, how it's happening is that it allows the government, because they're now funded, to do certain behaviors that they wouldn't be able to do otherwise. And those behaviors, like tax cuts and grants and all kinds of different things to certain class of people, those people have a propensity to then put those gains into the financial markets. So all roads lead to the financialization of the system when you're dealing with a world reserve asset like the US dollar. Anyways, fascinating stuff, all very interesting. We want to keep our eyes, as always, on the dollar, on equities, on policy, because as those move, so your futures move. And we're here to make money and to trade what happens. Peter, anything else you want to say before we leave?
Yeah, there's an interview that just went up. If you haven't seen the last Trading Bot sessions, maybe Tom, you can pull that up there. Trading Bot sessions with Mike Christensen. He does these interviews with traders. They're talking a lot about prop, but not only prop. Ernie Chan is up there. That's doing well. You should definitely go and check that out. He's a quant, and he provides some really valuable insights for the market. You can see that here on screen. Let me pull that up. So Ernie Chan, we just released another one from Stanzi Benz, and there he is there. He provides really valuable insight as well. Successful traders giving their tips, letting you know about their journey. So I highly recommend you go ahead and check that out. And then we have actually a video coming out soon with our very own Trevor here from TradersPost, who talked about trading prop, being profitable, and how that helps him, especially with his wife. It was interesting to hear a lot about the relationship with his wife and how being a successful trader helps him there. So I highly recommend you check that out. Tom, price action live yesterday, today, this week. Was there anything that interesting that happened? I saw there was a video where Mike, two accounts were passed. You want to just show that? Just click on the video tab. 2 accounts were passed. What does that mean?
It means that he went from evaluation to funded, so that he can actually go ahead and get more payouts from prop firms. He's killing it. Mike has learned the power of negative RR and the ability to and the ability to take more risk but make more gain in the short term is very interesting. And he's doing well. He's doing fantastically. When you're dealing with prop firms, is a whole other kit and caboodle, because there's no such thing as buy and hold with prop firms. You have to have a whole other different strategy. So definitely go check that out. We are on Price Action Live Tuesdays to Fridays, 9:30 a.m. Eastern Standard Time, and we trade live in front of you. Our own money, our own capital, our own accounts. It's pretty fun, and we're looking for people to join us. So if you want to come online, that'll be fun.
Well, that's it for me. Thank you, everybody, for watching. Really appreciate it. I'll let you sign off, Tom.
All right, guys. So as always, we'll be back next Friday for more after hours at 4 p.m. Eastern Standard Time. And until then, we wish you, as always, happy trading.